All right. So we talked about the whole notion of paying yourself first, and kind of why that makes sense, whatever method you use. But again, the easiest, simplest way is to pick one financial institution, whatever. Maybe it's the same company that you're working with, like the university here is aligned. Well, you could be aligned with a number of them, but one of their choices was Fidelity. So Fidelity or T. Rowe Price or whatever. There's huge, big mutual fund companies out there, and maybe you're already associated with them. And just for simplification, for ease of mail at the tax time, you might want to keep it all in the same company, all things being equal, if you're happy with them. But anyway, you get that thing set up, and then it's just dead easy. It's online. You can change the amounts, the percentage that you want to deduct, and they're very easy to work with because they're interested in not so much your money today, because maybe we're just talking small amounts, but they're interested in when you become a high wealth kind of individual, they're going to set you up for that. And TurboTax is kind of the same way. These tax companies, they'll give you free stuff now. It's legitimately free because, again, they're trying to make it easy for you, and then later in life, you'll be more apt to pay that $80 or whatever they charge for a normal, complex kind of tax return. For a simple thing right now, if you're not itemizing in that, they'll do it for free. So it's just quicker and easier. Now, what you want to absolutely stay away from, unless you're in that kind of bind, but anything that gives you an instant refund, that's not a refund, that's a loan. And there's interest charged against your future, your future return. Because IRS, there's a government, they don't do things instantly. So if you're getting your money today, you're getting a loan today. And besides, it's not, you're not getting money from the government. It's your money that you gave them too much. You had them withhold too much. It's supposed to work out at about even. But anybody who thinks that they're getting a big tax return, refund, I'm getting one over on the government. No, you just gave the government a loan for a whole year. Now, if you start not having enough money withheld and you owe them big chunks of money at the end of the year, the IRS doesn't like that at all. Because now, they're giving you a free loan, and they'll force you into doing quarterly payments and all of that kind of stuff. But that gets into more complex situations, self-employment type situations. But anyway, so it should be where it's almost a wash at the end of the year. Depending on how your investments work, how things work, you should have about the right amount withheld. So, but we're not quite at tax time yet. But realistically, from my point of view, you should have been, the first time to look at TurboTax or pull out, your tax forms and stuff. It's not in April. It's far too late. You have to do it in that preceding year when you can still make changes. If there's something that you want to change other than you can do IRA deductions and a few things after the first of the year, but for most things to do with the IRS, once the first of the year has occurred, everything's frozen. So you'll see companies, say, well, we need to spend some money by the end of the year. We need to do this by the end of the year. And you can do that as well on your personal level. You can, look at your situation and maybe characterize your income in different ways, or take income early, or make investments early, or sell stock beforehand. Let's say you're going to college, you're not making much money, you've got some stock portfolio where you're making a fair amount of money, and next year you're actually going to be working. You probably want to sell those stocks in this year and have that income reflected on this year when you're in a very low tax bracket, and then next year when you're making more money, you want to keep a bit of a lower profile. But anyway, however it works for you, but you have a lot of, there's no reason why you shouldn't do sort of a trial run of your taxes to see where you're at, before the end of the year. So back on the managing, don't carry balances on credit cards, automatic deductions, how do you do that? 401k, especially if there's matching, and review itemized statements for show spending areas to potentially cut. So again, like I said, it also identify fraud, which is, fraud it's so prevalent out there. I had an account that I didn't use. For some reason, I had this, when you open up a checking account, they usually establish a savings account at the same time. I didn't ask for it. I certainly did ask for overdraft. Anyway, some person established an automatic debit out of my savings account that I haven't used in forever to pay her cable bill down in Florida. And the bank just let them do it. I mean, they absolutely didn't do anything about it. I wasn't tracking it, and it was like $60 or $80 a month. And it went on for like 7 months. And all of a sudden I noticed my credit card balance on a credit card that I don't use much, I just had it there for overdraft protection, it started to get a balance on it. And so I went back and looked at it, and sure enough, it wasn't even fraud though. I mean, she used her own name. And then, I mean, good bank, USA, and it just gets lost in the shuffle. It was upsetting. And the bank said, no, you're not covering it. Well, yes, you will. And so that went on for 7 months, and I pretty much got everything out of that bank until then. And then I finally ended up writing a letter to the president of the bank, and finally somewhere up at their level, they're like, this guy's been a customer for a long time. And anyway, they finally ended up paying for it, but it was only because, and the bad part on my part was that I'd let it go on for 7 months, and so there's no way they were going to be able to recover this thing. But I had to get a police report. I had to do all this extra stuff, but I'll do what I got to do. Anyway, just you got to really be careful with that stuff. It's pretty rapid. And then this one, I did nothing. I mean, I don't even know how she got the number. Just guessed it or whatever. So anyway, I could have caught that if I was reviewing that one. So that's some homework stuff. We'll talk more about later. But it's just going to be a credit thing, or not a credit thing, but a budgeting thing. What I'm doing is I'm trying to paste some of the homework in here so that you can, look at the different versions to make sure, when there's different problems in different books. So the tax planning aspects of this, though, what I want to do is number one, I'm not trying to sell anything to anybody, but using something like TurboTax is fairly advantageous. Number one, because you see all these payments, you have to pay this or pay that. Nothing is charged until you actually file. That's when they collect their money. Does anybody use TurboTax? So you guys kind of know this. This one, I've got a real account that I use for my stuff. It's got all my old returns and stuff on it. I just created a bogus one just for purposes of this class. So there's nothing to prevent you from going, I'm thinking about buying a house, how's it going to affect my taxes? I'm thinking about doing this, doing that. What should I do? You can kind of run those scenarios on a bogus TurboTax, and it's absolutely doesn't cost you a dime. So I've set up a kind of a template here, TurboTax, and I went through and I just sort of populated it with some numbers. So they'll go through and again, the way the tax code is written, it's like all these hoops and things you have to jump through to get the maximum amount of money back or the least amount of money withheld. But it's all written by politicians that they don't always do things right. In fact, they often don't. But in the tax code, the way the thing is set up is it's trying to incentivize behavior that the government wants to encourage. And sometimes it's good stuff. It's if you adopt children, there's benefits for that on your taxes. If you put in energy efficient modifications within certain limits, there's things for that. Buying a home is looked at as a good thing. Having kids is it's you don't want people to be in stressed economic situations and not have children. That's like a Southern European thing where the population is like halving every couple of years. In Germany they give you what they call Kindergeld, literally cash payments for having children, because their population rates are dropping. In the U.S. we're doing all right, but in Southern Europe, though, for example, for every 2 adults there's 1 child born. So every Spain, Italy, it's almost uniform across those places. So anyway, there's incentives to have people, have children. The other thing, though, is you'll find out later in life is that as your income goes up, a lot of those good deals go away. oh, you get, great college benefits, this is deductible. Not if you're over a certain income level. Kids are not deductible over a certain income level. So a lot of those things go away. And so that's why, a very small percentage of the taxpayers actually end up funding a large amount of the total taxes. It's, believe me, without the 1%ers, it would be a problem. And that whole notion of we can tax the 1%ers and pay for all the government, obviously there's only 1% of them, and they don't have that kind of wealth, and you diminish it. So anyway, it gets political, but there's all sorts of behavior where you're basically a little rat trying to get the most amount of government cheese you can by going through the wickets and doing the different things. So tell us about yourself. They're trying to sell you whatever product. So if you have a complex situation, they're going to be boosting you over in this home premier kind of thing. So yeah, we got children, own a home, deductions, stocks, bonds. I don't know. We'll skip the having a business, but I do all my stuff on here. I've got an LLC, and I do it on my personal taxes, so it just makes it that much easier. Plus, the business, go figure, loses money because I buy airplanes and do all kinds of other stupid stuff. I intentionally try not to make much money with that business, and so it gets me a bit of a write-off. It's all legal, completely legal. So anyway, you move on. You select whatever product, and this is the beauty of if you're kind of a return customer. I haven't been on this thing in a while, but it should come, start to be sort of pre-populated, with some of their data. Maybe they scrubbed mine because I didn't take it through to completion. But I actually didn't file this report, so maybe that's where things are going horribly wrong, because they aren't going to find an account since I never filed for it. Anyway, we'll just pretend like we did it on paper last year. But what I want to do is I want to show you some examples of what you can do. So when you talk about buying a house, when you talk about giving money to charity, you can actually put in your actual numbers, and it's not hypotheticals. You can put in realistic numbers and see how, for example, buying a house affected what's going on. So yeah, I'll just put bogus names in here. I don't want to be born. /01. I was born in 79. So yeah. Well, this is stupid. Okay. Now, if you're married, you got different options. So you get different filing statuses. You can file single, which means you probably need a clobber. Okay, because that's you've got, if you're making $100,000 as a single person, you're looked upon as the ability to pay quite a bit more than two people jointly making $100,000. So you're going to be in a different tax bracket. You can also, if you're like a head of household, which I am, you can also basically enjoy the same privileges as if you were married. But anyway, you're gonna pick a status. So we'll say married in this case. So and owned a home. Let's say there's a college student in there. Had a job, donations. So, I mean, if you haven't done this before, it's pretty darn easy, and you just sit here and, did I do this? Medical expenses, job expenses. Pretty much everybody has job expenses. I mean, you need to maybe be a little creative, but you can think about things. I mean, I was in the military for a number of years, right? In fact, I'll get a haircut tomorrow, but typically it was kept short, shorter than if I wasn't in the military. So, yeah, some of that stuff's tax deductible. Uniforms, publications. Especially for, this will be very relevant to you all, job search expenses, those are all tax deductible. So there's all kinds of expenses that, if in doubt, check that you probably had them.
And anyway, it'll go through and all I can say is basically no. It's not like none of this is going to be reported to the IRS until you actually go through. When you're making, you have different kinds of incomes. You've got your regular income that you're going to normally see in a W-2. Then you've got investments, hopefully, pretty soon. Okay, so depending on your investments, you'll have different things. You'll normally have an INT and a DIV. So interest, if you just have a savings account, it's probably some small amount right now. But if you have something like stocks and bonds, things like that, where you get dividends, that'll be on a DIV. You may have retirement, probably not. Miscellaneous incomes, 1099s. Those things show up quite a bit. You get those for, especially if you're doing like contract work or something, they'll issue 1099s. So anyway, let's check a couple of those. That's probably pretty typical. And then, it's going to go through all this personal info. It's going to, want my social and all that kind of stuff. I'm going to try, obviously I'm not going to put in my real data here, and you can put in whatever name you want. What I want to do is I want to start getting to the meat of this. So, anyway, if I had used, taken this thing all the way through to completion last year, it would have already had this stuff pre-populated. Let's see. It may have kept it. Yeah, so it's got UAA stuff in there, student, 1, 2, 3, whatever, social security number. I just had to put in enough data to get it to work, right? Because what I want to do is I want to get into the income and deductions. Spouse's personal info. So obviously if you've got some sort of strange, kind of thing, foreign spouse, something like that, you might have to fill out some different details. There actually, it depends on the tax laws. It changes back and forth, but sometimes there's, what's viewed as a marriage penalty, or there's also, it's supposed to be, where there's a benefit to being married, but there have been people who, will legally get divorced, and file their taxes as singles and then get married again afterwards, and they're basically taking a honeymoon each year with the money they're saving. They've gotten rid of most of those loopholes now, but you, as long as you're in that status for a portion of the year, you can jump into there. Spouse, values required. If somebody else is claiming you, no, you can't do that. Spouse legally blind. So again, they're not going to, beat up on the person that's sight impaired. I mean, there's some, things that are good. My kid, same social security number as mine, which is weird. It's same for 2015. So anyway, what I've done here is, okay, so I'm already up to a $4,000 tax break based upon the child, right? That's the child I support. Now, it can't be, if you're separated, something like that, only one parent can be claiming it, typically. Mailing address, I'm going to try and skip through that. Did you make money in any other states? It'll do state returns, but a good thing in Alaska, you don't have to mess with that. So now it knows, I'm married, not legally blind. It's got all this different information on me. And then let's look at the income. So for most people, there's going to be these are all business expenses, not your typical income. Withdrawals for retirement, you're probably not going to be doing that for a while. So we're going to get more to the W-2. So in this case, for round numbers, I'm saying I'm making $100,000 a year. Okay. Now what happens is out of that $100,000 per year, when you're looking at your statements, you're not on your W-2. Well, it'll actually end up being on your W-2, but there's monthly withholdings, right? So you're already, in essence, sort of prepaying some of your taxes. Not Social Security and some of the unemployment benefits. That's money that's basically gone. In fact, that's kind of how Social Security is now. The concept of Social Security is you're supposed to get it back, but in reality, Social Security is kind of broken. It's going to be means tested, and you may get a part of that back. But anyway, on your pay stub, you'll notice that a certain amount of federal income tax withholding has already been taken. And so in a perfect world, if things are pretty normal, and let's say you work for the government or something, where there's not a lot of dynamic, you're not getting commissions and you don't have your income fluctuating, that amount being withheld should hopefully, if you've got things squared away, should be roughly about the amount of money that you're going to have to pay in taxes. Now you may be able to get some more money back if you can, say, do the 401k and do some money tax deferred, or maybe you've got some excess deductions. You're donating a fair amount of money to charity, or you're doing other things that are incentivized in the tax plan. So anyway, I'm making $100,000. I'm not showing that I'm making any money on investments just for simplicity, and now I'm just going to wrap up the income. This foreign bank account and trust, that's kind of a big red flag. I have to check that because I've got a house in Germany, but I never keep more than $10,000 in it a year. And if you do that, then it's kind of transparent to it. So anyway, for most of us, it's not going to be a big deal. But now you start looking at the tax break. So you could be in November or whatever and thinking about, I'm thinking about doing this. I just, looks like stock. I'm making a fair amount of money. If I sell it this year, what's that going to do to my tax situation? I could wait till after the first of the year, and then it's in the next tax year. So you can run through these scenarios before you do something that's going to have tax implications. Like I say, once the first of the year comes, it's game over. That stock that you sold, you owe the taxes on that at this point. So it kept all the information from last year. So it's got, in this case, home interest and charitable deductions. So let's look at some of those. So home energy credits, child dependent care, tax preparation fees, that $80 or whatever you're spending on TurboTax, that's deductible. If you're paying a person or you're buying books, all that stuff is tax deductible. Now, we'll talk more about this in upcoming weeks, but there's a difference between a tax credit and tax deductible, right? If somebody is giving me a tax credit, it means, a $400 tax credit means $400 is taken off my taxes. That's a great thing. Tax deductible, let's say I give somebody some junker car and it's worth $1,000 and I'm in a 28% tax bracket. So how much value do I get back by donating that car? Well, certainly don't get $1,000, right? I by reducing my income by $1,000, which is what that's going to do, I'm able to save $280, right? Because I'm 28% tax bracket, so we used 1,000 as an example. So when somebody says something's tax deductible, that's good, but it equates to that savings in your tax bracket. So in this case, it equated to a value to me of I'm $280 wealthier, so to speak, by giving away that car. So tax credits are certainly what you want. Tax deductions are certainly nice to have, but they're not the same thing at all. So home energy tax credits, obviously that'd be a great thing. Child care credit, you saw my taxes went down by $4,000 on that one for that. Preparation fees, expenses, scholarships, 1098-Ts, those are those details. And if you're under your parents, if they're paying for your education or they're claiming you as a dependent, that's why they want those documents from you. So here are some things that we had. Okay, let's look. What I want to see is normally we have the tax amount to be paid over there on the left side. So it'll pop up here pretty soon. But let's say I paid $18,000 in interest, which isn't that unusual, especially when you're buying a house. When you're first buying a house, when the first payments are coming out, most all of what you're paying is interest. It's only later, as the loan matures, that a more significant amount of the principal is being paid. So let's say your payment's $2,000 a month. When you're first buying that house, it may be $1,600 per month of that is interest. Accrued over 12 months, you could be looking at something like $18,000. So I'm going to go ahead and put, yep, I paid a mortgage to Wells Fargo, and I'm not checking any of those blocks. They send you a document that tells you there's a whole collection of tax documents that you get at the end of the year. One of those would be the amount of interest you paid. But it also, down in this text, there's a whole lot of little rules that are spelled out for you, fairly easy to read format. And if you had to dig in the IRS regs to actually get this information, it would be pretty painful. So it's helpful that they have this information kind of on there. And they've also got the publication if you really want to get into it and look at the specific details. But okay. I'm going to click on the show me my refunds so far. So actually it says 0 right now. Property taxes, obviously those are going to be going up a bit. You can do it on your main home and your rental home. So, it does not include the rental home. Now you can have a second home, but that's why there's IRS rules, how long you lived in that second home. And if you're living in that, if you're renting it out more than a few weeks a year, then you can't deduct that property. So I'm saying $3,600. I'm just using last year's figures. Child tax credit. Earn income as an inmate while on work release. So they have to cover all these strange situations. Hopefully you can check no for that. Turns out you don't qualify because probably my income's too high. Donations to charity. Donations to charity, that's 50% charity. So, whoops, I wanted to put something in there. So this is where, if you're going to give stuff away, you always want to get a little bit of a receipt for it, And the people, this is, so if you've got the option of going to Goodwill or whoever and dropping stuff in a bin in the grocery store parking lot or actually taking it to the place, taking it to the place is probably a better option than ask for a receipt. And they're fairly easy to work with, but you have to establish some sort of value, so obviously if you say your old socks are worth, $500, there's probably going to be a problem there. But if you're legitimately taking reasonable stuff, this is one of those documents that, would become part of your big tax file. Hopefully you just scan it in and save it as a PDF, but you would be expected, since it's now part of your taxes, to keep it for that 6-7 years like we talked about. So if you want to say you did items, I'll go ahead and value them. And, the date of the donation, what they're talking about here is they want to make sure it's, in the correct tax year. So we're always working a year behind. So those are 2015 donations. Household items, whatever. The more specific you are, desk, and let's call it 1,000. How do you determine that? That's what it's worth, comparative value, comparative sales, something like that. It's a pretty nice desk, actually. But anyway, purchase price. So now it wants, maybe that desk I paid $3,500 for it, and I got it anyway, this can be a bit tedious, but I don't know, 1970. Maybe that's not quite an antique, but anyway, we'll put it in there. Gives me a little Scooby. Items for church. Yep. But anyway, you go through and you just, medical expenses. Medical expenses depends. You'll see certain things are limited to a certain percentage of your average gross income. And for most cases, you need to be fairly sickly before it starts to be a deduction. So it has to be a certain percentage of your average gross income. So I can put something in here, where's it going to say? More than 10% of your AGI. So I'd need over $10,000. So that's, did I have $10,000 worth of copays or whatever? Probably not. So it's unless you've got some pretty bad health, probably not going to happen. Job-related expenses, though, this is where I'm fairly detailed. And I tell you what, I mean, a lot of this is pretty involved. I mean, just keep track of stuff, and you'll build up things year after year. And oh yeah, that's right. I have to do this because of my job, and this, and you'll find out what's legal and what's not. What's allowable and what's not. But especially if you're in a position and you're subscribing to some sort of magazine because it's makes you more professional. Depending on your education, the education can go in one category, or if it's strictly related to the job, it can go in that category. So it can get pretty involved. I'm just going to say, well, union dues, professional subscriptions. So they've got some of the easy ones, uniforms, if they're not reimbursed. Now, if the employer is giving you uniforms to wear, then you didn't pay for them, so you're not deducting them. But if you did, so it'll take you through. So let's put military, not any longer, but and then it'll ask all these other questions, which I don't want to do. But again, Gulf Opportunity Zones, there's certain things that are political that have happened that have put in certain areas in better tax privileges. What I'm really trying to do, home office expenses, do you have a home office? Vehicle sales, okay, I'm just going to start checking no to these. Computers, office machinery, so it's trying to help you, and then it's going to depreciate these items, and it's going to keep a record. And if I was doing this year after year, it would have a list of these items, so I kind of have a head start. And again, that's why it pays to sort of shop around and find what tax software we're going to use, and then try and use it year after year, because it'll be helpful. Other expenses, unreimbursed, so travel expenses, meals, again, has to be related to the work, and it has to be unreimbursed. Has anybody ever done taxes like professionally or whatever? So, okay, good. So have I said anything completely wrong so far? Did you go to one of those like weekend courses and then you did the preparation?
No, I worked for an accountant for years.
Oh gosh.
Taxes.
Well, then we could. Yeah.
I think you have 2014 income, that's why your refund amount is not.
Oh, is that what I did? I'm going, why is this not? Because that's what I'm trying to get to. Okay, so personal info.
Think back to the wages.
Yeah. Where the heck was it? Well, there's different ways to get through this account. Isn't there a way to just go directly to it? Your income. Yeah. Okay, so that's why the number's not jumping around like I wanted it to. Yeah. So obviously, employee number. I'm hoping it doesn't cause me any trouble here. But try and leave this stuff blank. But wages, tips. So what software did you use, or did you use any software? Was it standalone or?
We use Pro Series.
Okay.
Which is, it's made by Intuit, which TurboTax is, but
Yeah.
where you can see line by line,
Yeah.
rather than answering questions.
Okay, so it's saying I owe basically $8,000. But you know why it's saying that? Is because there's no taxes withheld. So let's say, $7,000 had been withheld. So now, that's a number that I can kind of, the IRS is not going to be real concerned. I'm not going to be real concerned. Did you ever have any of your employees that they have to do their quarterly payments and?
Yeah, I do, taxes for one day, estimated to about 30,000 work in addition to her regular payment at the end of the year. So she gets hit with a big penalty at the end of the year because she doesn't make them all.
Yeah.
But the penalty is actually less than the interest she didn't make, so she doesn't care. So you watch people play with it
Yeah.
a lot, but yeah.
Now, how does she change the amount being withheld? I mean, and other than, moving the dependents numbers around.
So she owns her own business.
Yes.
You change your W-2, your
Right.
W-4 to fluctuate your withholding
Right.
based on what you want. But when you do like TurboTax or tax return, it'll spit out what your estimated should be
Exactly.
the next year based on what you did this year. And you can just wide it out. You can go online and pay whatever you want. You're not held to make that payment. You're just going to have a penalty if you don't pay enough during the year.
Yeah. So,
Does that answer your question?
yeah, I mean, with a small business, you have a lot more options than if you're working for, let's say, the government or something. You don't have that sort of flexibility. You can't necessarily, and that's one of the reasons I have a small business, is to give me a bit more flexibility on some of these items. But there's a whole different set of rules. So I've given kind of the top level version of how all this stuff works, and because I can't necessarily teach you all to be tax people. And I want to get to this section in here where I was doing the deductions, but usually there's a here we go, deductions, credits. So, getting back to this mortgage interest refinancing debt, you can see that, you're like, golly, you paid $18,000, dollars in interest expense, which is, obviously quite a bit of money. But let's say I'm in a situation and I'm a renter. I'm not getting that. So let's say in this case, rather than having $18,000, so look at this number over here. So it's saying $891 is owed. And going back to the same Wells Fargo, let's say I sold a home, I'm in a rental situation. So, that's that incentive. By having that interest tax deductible, that was quite a bit. And while we're there, the landlord, I indirectly, property tax is still paid on an apartment building, and I'm still, covering that for, that's factored into my rent. But when it comes to taxes, no. So if I enter a zero into that one as well, because I don't get an itemized return, I'm not able to, as a renter, I'm not able to claim property taxes. So oops. So it stayed at 2461. Why did that happen?
They probably knocked you over to standard deduction rather than itemizing.
Yeah. So it's going to hit a certain amount. When we get into, okay, we've got itemized and standard deductions. There is, and that's where we're talking about the complexity of the tax forms. You can fill out all these documents and itemize your deductions. And again, this is something that you can do comparatively. And it's very easy to do if you're using TurboTax. You can choose to itemize, or you can choose to take the standard deduction. And the standard deduction is just some number that's basically artificially generated that
would, you know, give you a different option. And so what you're going to do is you're going to calculate both ways. Well, there's no calculation on the standard deduction. It's just the calculation of you putting your income and taking the standard deduction. If you itemize, and as you itemize more and more expenses, it's going to probably in most cases, it's not, you know, for anybody who's got a business or any sort of complexity, that's smart with taxes. In most cases, I haven't taken the standard deduction since I was 20. I mean, and that's where the normal TurboTax, the cheap free version, is no longer applicable, and that's where you're paying more. So for your, what types of businesses were these people involved in? Were they insurance?
Yeah. But we do a lot of different companies' taxes and personal ones and
Yeah.
all the things.
And there's nothing to be, you know, especially as you get into higher level type things, and you're kind of questioning yourself. You know, what they say is that people tend to overpay their taxes because they don't want to, you know, get in any trouble with the IRS. Well, you know, I'm not looking for trouble, but just the same, I don't want to overpay. So if I'm in that sort of situation and I'm having second thoughts about something, or especially with like foreign property or stuff, having somebody professionally do it and kind of compare the numbers is nothing wrong with that. But
you have to stand behind you if you're audited. So
that too.
So you know the laws.
Yeah, but you don't want to be the sort of person where I don't know anything about my taxes. They just do it. You know, I'm a proponent of using TurboTax and automated programs to do kind of the menial calculations and do some of that stuff. But the way you live your life, spend your money, and conduct your finances can greatly affect your tax burden. So you need to know enough to be smart about it, but also if you're a higher wealth individual, there's a certain point where it does make sense, and you can probably save them quite a bit of money. Even on these lower things, you know, on TurboTax, they'll stay behind some other stuff, but they actually have a little added service, or you know, tax defense or somebody like that will perhaps you know, will actually represent you. But that's on the off chance you're going to be audited by the IRS. You can
I
always
love
just do it.
TurboTax for the basic tax return. It's easy. It teaches you things that you need to know about your own finances. It's complicated.
Yeah, you really end up using three things in my mind. You know, something like TurboTax, because TurboTax will kind of peg you for, you know, it'll ask you about this deduction, that deduction, and it kind of maybe, I mean, you can drill down through some of the menus and get more information, but it's not always comprehensive enough, at least not that I'm going to stake, you know, getting in trouble with the IRS over. Then there's usually other books like Ernst & Whinney and other tax guides that are published for each year. They're in a paper format that are a bit more comprehensive and are derived from the actual IRS regulations. And then the last thing before I do something, because especially with a foreign real estate, it's just not situations that come up, is I'll actually look at the source IRS documents. But if you do it the other way around, you start with the IRS source document, you'll just be, I mean, you need to, at least in my mind, unless you're a lawyer, you need to start the other way around and it's unfortunately there's not a single source, because as good as TurboTax is, I think there's some situations that are missed now and again. But it will keep you out of trouble for the most part. And it will certainly suggest things. And then you can just kind of Google and search and do stuff. And believe me, employee expenses, home office type things, it all adds up. And the thing is, too, that, like I say, with income, if your income exceeds a certain level, all of a sudden things that are tax deductions like child credits and other things quit being deductible. So you need to really do what you can to get below those levels. We'll talk more about tax rates and the rest of it when we do some of these calculations. But we'll spend another week on this, and maybe we'll get more in depth, but there's marginal tax rates and there's average tax rates, and the way taxes work is that you pay incrementally. So as you know, we've got a progressive tax system. What that means is that the lower income levels, there's less tax assessed. So let's say you're making 20 grand, 40 grand, the tax rate will be quite low on that, and then it'll get up to say 25%, maybe at 80,000. You don't have to look at the tax tables because there's a whole lot of variables depending on your marital situation and everything else. And let's say, just for argument, you get from 80 to 100,000. Now you're in a 28% tax rate. Now that doesn't mean that, let's say you make 100 grand and you're in a 28% marginal tax rate. That doesn't mean your whole income is taxed at 28%. It just means that incremental, that margin from 100,000 to 20,000, or from 80,000 to 100,000 is taxed at 20%. So, and then there's, it's just very, very complex. And now with the healthcare situation, even more so, because your eligibility for that healthcare, we have 3 different types of healthcare that we'll talk about, but you can be pushed from basically a free category into a paying category, where is actually where the Affordable Care Act and Obamacare works, and then you get into Medicaid when you actually get or Medicare or Medicaid. One's a welfare tax program, and one's actually a program for the elderly. We'll spend more time on that. I think for tonight, though, we'll probably, because I'll look at some more examples in here and come up with some more information. But it's huge. I mean, this is where, if you're going to obsess on budgeting and things like that, your taxes are really where modifying your lifestyle without great impact on your life. I mean, the quality of your life, but keeping track of things over the course of the year and knowing what's important and what's not can have a huge impact on the actual amount of money that you are able to accumulate and have at the end of the year. But again, my main thing about taxes is do not wait till taxes are due to calculate your taxes. Do it earlier. Get a rough hack and modify things as necessary to minimize your total tax burden. There's nothing wrong with that. There's 2 concepts. There's tax evasion and then tax avoidance. And evasion that's what you go to jail for, not paying your taxes. But avoiding your taxes, that's why the code is there. You're trying to pay the minimum possible. Warren Buffett and all these other guys who say, we got to be paying more taxes, they're also in court fighting tooth and nail to pay the least amount of taxes that they can legally do. So it's not unpatriotic to try to minimize your tax burden. Pretty riveting stuff, huh? I can tell you guys, late in the day. Anyway, appreciate your help, and we will see you next week. Questions? No.